We're joined right now by Diane Swonk, chief economist at Mesirow Financial, and our guest host, Tom McClellan, here for the whole program. Diane, I'm going to start with you. I mean, which is it? Is it really bad for the economy if we see higher oil prices? Or perhaps this could actually signal that there's more demand and that the consumer can withstand these higher oil prices? Which is it?
I think that actually the reason we saw higher oil prices earlier in the year is not just the upside economic surprises, but also a lot of turmoil in the Middle East. We saw everything from the Arab Spring and monarchies paying off their populations and having to have a higher threshold on oil prices and holding oil prices up to maintain their own budgets. We also saw Iran, that still is an issue out there.
Forgive me, I just want to jump in here because what you're saying then is concerns about problems in the Middle East, that then is driving prices higher. I actually want to bring in Adam because Adam did a very interesting chart, that really looked at that just about a week ago, right? Speculation and concerns about, Middle East problems. I mean, how much did you see that weighing into the actual price?
Well, I'll tell you what we found was that speculation was at all-time highs, and yet oil couldn't seem to get above $110. And I guess, Diane, it begs the question, if it's not the speculators that are driving oil, then why is oil up at 110 bucks?
Well, that's the issue, is it's not just speculators. It's also concerns about the supply of oil coming out of the Middle East. So that's not just speculation. And today we got confirmation that, guess what? We're not consuming as much oil. We're not driving as much. And global demand is down. And sure enough, oil prices came down. But until you got the reality shock of that, oil prices have been pushed up. So I do think, the fact that oil prices at these kind of levels were really pretty stunning, given the slowdown in growth in Europe, the collateral damage to China, which is one of the biggest marginal consumers of oil, which has slowed quite dramatically. You look at the demand and the supply factors, there were some supply shocks that also helped hold oil prices up, but the bottom line was it really wasn't reflective of global economic growth. So I think there's so many complex factors. Don't you see that as a good sign? I mean, isn't it kind of good that oil has a very high price level when you've got all kinds of problems going on in Europe? You've got concerns about, whether or not our economy is going to be high oil prices. I mean, this is only good. It's good for the state of Texas, and it's good for Saudi Arabia. I mean, come on. For the U.S. consumer.
No, listen to what I'm saying here. Why couldn't it be good? Because what it's signaling is that people want oil, need oil, are demanding oil, and are willing to pay for oil. Because if consumers said, we're not going to pay these prices, then you'd see that start to reflect.
Consumption's down. That's the point, is the consumption of gasoline at the pump is down.
Tom McClellan,
it's down but quite a bit.
You want to weigh in this?
And the reality is that there were also. Yes. We also look at consumption.
Hang on, Diane. I just want to bring in Tom to see.
I'll agree with both of you. I'll agree with both of you. Consumption per capita in the U.S. is down to its lowest level in 30 years. We are doing all those things of driving less, taking the bus, buying Priuses, and it's down to the lowest level per capita in 30 years. It's not down to the lowest level raw terms because population has been growing, but the demand overseas has been growing even faster. And what most people don't know is that the U.S., because of low natural gas prices, we are now the low-cost producer. We can import oil, apply natural gas to it to help refine it, and sell the gasoline more profitably than anybody else can. That's why we're now a net exporter of gasoline and a huge importer of oil still.
Diane, you're nodding your head.
Yeah, well, that is really important because in unseasonably warm winter weather, low natural gas prices, major buffer for the U.S. consumer as prices at the pump went up. As we move into spring, even as prices come down a bit, they're still elevated, and you've got all of a sudden people turn on. In Chicago, we had our air conditioners on. I mean, this is insane, this weather. I don't know if it's going to be 150 in July or snow, but the reality is that we had a major buffer in low natural gas prices and in an unseasonably warm winter weather that allowed us to go through this period and some employment generation, which is great.
Well, Diane, let me ask you.
We saw a major trade-off in services consumption, and everybody, sort of, when they look at consumption, look at retail sales, but when you look at services consumption, where a lot of discretionary spending is, which includes medical services as well, the largest slowdown in medical services we've seen in decades. All
right, so Diane, let me ask you, we've probably only got 30 seconds here. Stephen Shork has done a lot of work on at what price do you really start crimping demand. He says $4 to $4.25 at the pump. You're an economist. What does your work tell you? Where does high gasoline start to cut off demand?
Well, it cuts off demand much sooner than that if we hadn't had the buffer of low natural gas prices. As we move into spring, I think we're going to see much more of a crimp, even as prices at the pump come down. And so, there's a lot of stuff that shows trade-offs as low as $2.65 to $3. It all depends on, again, what are the offsets and buffers.
Okay, so
elsewhere
bottom
in the
line,
economy.
you see this as a negative for the economy, Diane. You don't see it as entirely demand-related. It's more tied to Middle East concerns and demand that's not necessarily coming out of the U.S. It's really going to crimp the U.S. consumer. I don't know if I entirely agree with that, because I'd say, hey, if we start to really get some jobs, then maybe people can afford a little bit of a higher oil, and maybe that's actually a bullish sign for the markets. I don't know. We're going to continue the debate.
And a lot of the jobs data suggests now that seasonally we added about 74,000 or so extra jobs in the month of February, and we're going to lose 54,000 in the month of March as we move into more seasonal weather. So, the job situation clearly. I saw Ben on, give the speech at NAVE on Monday, and you know what? He's worried about the labor market.
Yeah, and so are you. It sounds like. Okay, we're going to leave it there. Thank you so much, Diane Swonk from Mesirow Financial.